Hey, what's up, everybody? Coming back at you with another Wall Street Saturday video. This is a super exciting time. We're definitely in beta mode, so we appreciate you guys hanging out with us during our growing pains. I wouldn't really call it growing pains, though, right? I mean, it's just us experimenting with what works and what doesn't work. We go over the analytics and we try to figure out what could be best for our viewers and our future.
Yeah, they're just feeling the G forces as the rocket ship takes off.
Yeah. No, definitely. But as we get into it today, I just want to introduce myself. I am Josh Flores.
I'm Joshua Trusty.
Oh,
sorry.
Hey, I'm Joshua Trusty.
And Misael Gonzalez. So yeah, so this week one of the main stories that we saw was price fluctuation in natural gas and oil, especially in oil, as we were keeping an eye on it in the past few weeks. And in last Wall Street Saturday, we mentioned that it had peaked at $90 a barrel during the trading day, and yesterday, February 4th, it closed at $91 a barrel. So it saw a big spike on Friday, and as we continue to see tensions in Ukraine and Russia, I think that this is something that we have to keep monitoring, as there may be increased demand for war efforts and maybe arms productions. And the other story is natural gas. As Ukraine faces, possible attack from Russia, they would probably have backup from other European nations, which a lot of those rely on Russian natural gas to keep their homes, factories, offices, etc. warm. So the story about natural gas at the moment, there was another new headline saying that Qatar was speaking with the US and Europe to kind of see and understand the logistics behind a kind of shift from natural gas dependence in Russia to natural gas dependence from the West and American allies. And what they are proposing, at least Qatar, is that they, since the European nations have open investigations into long-term contracts that Qatar has going on, one of the things that they're asking is that they overlook that, that they don't, hit them too hard with the investigations. And the second of that is that they try not to sell natural gas outside of the EU. Currently, they do have selling operations, and so they want to make sure that Qatari gas is not being sold in Europe to other countries. So the closer we get, the more time that passes, we hear more and more, like I said, logistics between the U.S. and European countries to kind of see, plan for the worst case scenario, which would be like a total cutoff for natural gas from Russia into Europe, and how it would work out in case they need to, find a way to provide or maintain the natural gas dependence that Europe has. And the other story that we do hear is from our best, mentor, Ray Dalio, coming out with an article in Barron's saying that the easy money era is over, and that we should, measure how much our expenses are in a year and then double them, because we may see some rough waters ahead. A quick background on that is what he means by easy money is pretty much interest rates being historically low for about 10 and plus years since the 2008 crisis. As you guys know, the Fed did have several quantitative easing periods, and they've been progressively getting lower and lower from a high of 15% in the 80s to, probably 0.5% back in 2013. And we see now that we have inflation. Inflation is ahead after many years of the Fed trying to get at least 2% inflation. Now we're seeing 6%, a 6% rise in the CPI index. Ray Dalio sees that the area of easy money or low interest rates is gone. So we do have to be aware of that. Keep that in mind as you know, this may be part of the explanation of why tech stocks are doing not as hot as they have been doing in the past. Of course, because they are startups, they do require a lot of money for new projects, R&D, and that money has to come from somewhere. And obviously, the base rate for any kind of credit is the Fed rate, and then on top of that, it builds in terms of default, in terms of length of the contract or the loan. So it all increases borrowing rates or borrowing expenses for tech companies. If you're not well established, then you're going to suffer a little bit, and that's what we're seeing: a money flight out of stocks into more of the out of the tech stocks into more of the more stabilized and mature companies. So that was some of the things that we saw come across this week that definitely are impactful for at least the short-term outlook. So I don't know if you guys have any thoughts on that.
Yeah, like one thing that Ray Dalio has said before is that companies and like people tend to want to spend more money than they have on hand at the time. And so the only way you can really do that, to spend like more money than you earn, is just by taking on more debt. And so that really is what like helps drive the economy forward. People are taking on like more debt by, say, for example, taking on like a student loan so they can go to college and they get a really lucrative job, which allows them to pay back that debt. However, like once you start to raise like the cost of debt, that is like, say, like the interest rates, that gives people less and less incentive to actually take on more debt, because that means in the future they're going to have to spend even more money, to spend even less money than they are earning in order to pay back that loan. So that's just kind of like one way we have like a quote unquote cooling down the economy, just by raising the interest rates, and that is like one way we can like fight inflation. Unfortunately, it just means that stocks that are really dependent upon low interest rates and those easy money policies where the interest rates are just so low, like tech stocks, which are super high on growth, those are the ones that are going to be suffering the most. Whereas, say, stocks that are already profitable, say like oil stocks, because they're already like producing oil, or they're transporting it, or they're selling it, wherever they might lie in terms of the oil and gas stream, those are going to be impacted less by the quantitative easing because they're already profitable. So in times of like really low interest rates, companies and like investors are more focused on growth. Like, what are your prospects for the future? How fast can you grow? But once like interest rates become higher, then it becomes how well do you perform right now? And for a lot of companies, they're not currently profitable. So those companies that are not as profitable are going to be suffering quite a bit once the interest rates begin to rise more than they already have.
Yeah, just to kind of bounce off of that too, to give a little bit more background too about Ray Dalio, is that obviously he's been a very successful hedge fund manager. I guess it was just something that he's been good at his entire life. He's written a couple of books, and the purpose of him writing those books is because he wants to leave like things behind for his family, right? To learn, it's like the blessings flow, right? That's why. I mean, like, even the curses, right? That's why we're all born into sin, is because Adam and Eve were the first sinners, and like the blessings flow, right? That's why, like, if your parents own a business, you might just take it over. Again, not to beat a dead horse to death again, but just to kind of feed off of that, the thing that Ray Dalio is kind of mentioning too is about this easy money and everything. Is it kind of makes sense where we're at right now as a nation in the US. And I could show this chart right here. This is actually from one of his books and some videos, some other resources online. This is just a Google image here that kind of shows the production line right here. And that's kind of the growth that Josh Trusty was kind of mentioning. This longer flippy curve right here is the long-term debt cycle. And this right here is the short-term debt cycle. And so right now, I think that we could potentially be somewhere around here. And so this actually kind of indicates like a recession slash depression kind of area. And again, I'm not trying to make any clickbait. I'm not trying to like tell people they should worry or like stop living the way that they do or anything like that. I just think that again, this is just an opportunity, and it would just always be wise to just have an emergency fund as you're just living. I mean, I try to keep 3 months expenses always in my bank account, just in the event that something happens, and that money is not at risk at all, right? But what I kind of want to point out here was a little bit of what Misael was saying. So like the Federal Reserve and how that kind of like affects the way that we live, and why everybody should really be aware of what is going on over there and why it is such a big deal, and why it's such a big deal to us is because they can affect our lives in I want to say for sure three ways, maybe a fourth way. But obviously, everybody knows now that the Fed can print money, and they love printing money, right? And that's like one of the reasons why we're in the position that we are with the inflation rate that it is. And number two, they can raise and lower interest rates, right? That's one way that they kind of control inflation, right? And of course, like Josh had said, that has an impact on like the growth. Like it has a direct impact, right? It's going to be harder for them to borrow. And the third thing that they can do is that they have a balance sheet, and they can buy and sell assets from that, and that actually affects things like the actual value of your assets, right? Indirectly, right? Just because they're selling off some assets on their balance sheet doesn't mean that it's gonna like affect my car price or anything like that. I mean, like it will, but like it's not gonna be like too impactful. But eventually, it's like when you have 100 pennies, it makes a dollar, right? Like that's essentially how the Federal Reserve and the way that they're making their decisions and how it affects us. And so the reason why I want to point out this top of the line right here and this easy money not being so easy anymore is because, well, I mean, look where we're at. We can't print money. We're in a position where like it's we got to control the inflation, so we can't print money, and the interest rates are already low, and like that's how we help the economy recover, right? Like how like lowering interest rates is going to make it easier to borrow and grow. And so if they're already at zero, what are we going to do? And they've already given us stimulus money, right? Like they printed out so much money in 2019, in 2020, in 2021 that they literally gave it to us, like literally in checks. And so it really is kind of like this bottleneck right here, why things it are kind of interesting, and it's a very interesting time in the U.S. and really the world right now, because I'm more than sure the rest of the other nations in the world are doing something similar. It's a very big science experiment. So I know that's why Fed Chair Jerome Powell is being very careful with some of the things that he's doing, because if interest rates increase, we saw in 2008 when they did increase, a lot of people defaulted on their variable rate homes, right? I don't know if we're really in a position like that anymore. I think that fintech had a lot to do with some of those people that were getting approved for loans. And I think that the controls around those, listen to me speaking like an accountant, but I think the controls around those are a little more a little tighter. And so I don't know if we're like in that sort of a position right now, but it is definitely a strange time right now. And the easy money might actually be over.
Yeah, for sure. I mean, yeah, I think you said it very well. Not that we're about to hit a recession, but there aren't a lot of good things on the horizon that would tell us otherwise. So yeah, I mean, one of those signs, again, going back to the oil aspect, back in 2020, when there was like a lot of supply and very little demand because of how much people stopped driving and or flying and or using cruises, the price of barrel crashed to like into the negative levels for the first time in history. So we may also see in the short term, since now there may be like an increased demand and a very little supply because of how things were handled in 2020, we may see a gap that may bump the price of a barrel to maybe like 100 or 150, I mean, or 200. I mean, these spikes can come because we are in very, interesting circumstances. And so that's something to keep an eye out for, because ultimately we do, I mean, it's fuel is one of those inflexible things, that or flexible or inflexible, sorry, but regardless of how expensive it is, you do buy it every day because you do have to drive and get to places. So
right, yeah, and the technical term for that in microeconomics is demand inelasticity. So it's not very elastic. People won't like suddenly stop purchasing oil because it's more expensive, because they have to. It's necessary for say ICE cars to be used in order to get to where they need to go. One other thing I do want to mention is that with regard to inflation, is that when the Fed is starts cutting back on the easy money policy, that will actually benefit the dollar quite a bit, because at this point, pulling or raising interest rates is one way that we have of curbing inflation, which is actually already quite rampant at around effectively 6%. So that's one bright spot of the Fed, curbing back that easy money policy. But certainly for a lot of people who are invested in growth, like Kathy Woods, that's not going to be such a boon to those portfolios.
No, yeah, I was gonna pull up actually a supply and demand chart. You brought in a cool economic term that I haven't heard in a little bit, but this is kind of like what you were saying. And so kind of bouncing off that oil and gas that you were kind of speaking about, Misael, this right here, another economic term that I remember is the equilibrium, right? Would you all agree? But so this is where demand and supply meet perfectly. And this is where theoretically we all want to be in life, right? Like when it comes to anything, when it comes to video games, when it comes to food, we always want to be right here. But right now, where we're seeing gas and oil and gas right over here. So, and that's why the price of gas that you've probably experienced is maybe 30 cents higher than what you're used to paying, right? And so this is definitely something to keep an eye on. And one other thing that I kind of want to reiterate too, being in Houston, Texas, and it being in the financial world, I deal with a lot of oil and gas. And I know that with some of the experts that I speak, this equilibrium right here is where oil is around $75 a barrel. And so you saying that it closes at 90, and assuming, I think the highest that oil has ever been, maybe I want to say 100, maybe 120. If that's the peak, we're probably somewhere almost halfway in between that.
and this is yeah, great point. I mean, I think 120 is when there is reasonable times. I think it was back in 2014 when a barrel of oil was $100. These are abnormal times, so we may see a spike, an irrational spike in demand all of a sudden, because we saw something. If you see it happen in the downward, you can also see it's totally capable of doing it upwards. And so that's something that I'm really watching out for, because it could totally happen.
It's interesting because I remember about a year ago or so, I think we were prehistoric Wall Street Saturday era. We were talking about the price of oil, and I think Josh, you had mentioned that some people were expecting it to hit around $80 a barrel, and I was saying, man, I really hope it hits $100 a barrel. He's like that would benefit certain stocks like ET, and now we're at around 90. So I'm just kind of wondering where this could eventually go, especially if there's unfortunately a war catalyst at some point occurring this year. Hopefully not, but if that does happen, perhaps the price of oil will go even higher than it currently is, or maybe it's already that high because people are anticipating that happening.
Yeah, to kind of almost bounce off another video, we talked about Kathy Woods earlier today. One of the things that she had mentioned is that she believes that the inflation issue is not because of the printing of money, but because of the supply chain issues. And so I guess to me, I've been hearing less and less about it each day. I don't really know how big of an issue it still is. Like I said, this week was all about Kathy Woods. last week was all about the war and the federal chair minutes, right? And so I think the supply chain is something to kind of look out for, just because oil is used for everything. It's in our shirts, it's in our laptops, it's in this glass, this cup, not the water itself, but in the cup, you know. I mean, like, oil is used for like literally everything. And so if we can see the supply chain kind of easing up or even like tightening still, I think that's definitely going to have like an effect on oil as well. Whether or not it goes to like 100 or so, man, it's really hard for me personally to say if it is. I guess today I can see it happening. I mean, I didn't think it was gonna go over 85, right? That's why I was like so hesitant to first get into oil, you know. But overall, I'm still glad. But I still want to point out, man, my gush play, right? Last week we were at 105, right? 105.98, and it closed at 117. The only disappointing thing about this is that it did reach 124 something, which was yesterday 124, right? Which was actually a 52-week high, which it might actually even have been, maybe. Nope. Look at that. Look at that. Whoa, 80,000.
Whoa.
But what?
What
Look,
was going on
let's
beforehand?
look at what was the price of oil during that time.
Yeah,
2015.
it would be nice to get like an overlay.
You know what I mean?
Yeah.
Back in 20, I mean that must have been 2014. No, 2015.
Yeah, I think it was oh, where was I at? Oh, it's right. Where's my gush here?
There you go.
It's May 29, 2015.
Well,
The
that's
average
interesting.
52. Yeah, but I mean, this is definitely a strange security for sure that it would be 80,000.
I mean, you can barely even like see the line towards the end,
Yeah, I guess one of these would be a better measurement here.
or maybe like the 5-year one.
Oh, look at that. It was still at 12,000, 18,000. This is something I did not
Interesting.
know. I'm sorry for those who are on the show and
I
watching this.
really wonder what the Sharpe ratio would be like for this one, because I think that it would probably be low just due to like the overall performance of like, like losing 99% of the value over like a 5-year period. I don't know that the Sharpe ratio would be that favorable, but like I have been like looking into like some different like stock plays like in like the oil and gas like, space, and it seems like a lot of them have been doing really well just kind of like as a recovery play, because oil was like super low around like once the pandemic like first started, but now a lot of like the various like oil and gas companies that have gone up significantly. Like ET is like up by like around like 40% or so year over year. So that, I think, I'm not sure. I'm still trying to figure out exactly what uh, oil and gas like could have like what kind of place it could be in for the future, as well as what part would it play in a portfolio long term. But right now, I'm a little skeptical of the long term value of oil and gas, just because like you showed before, Gush basically lost almost all of its value over a 5-year period, and a lot of the other stocks I've been looking at in that space too don't really seem to outperform the market, or even like some other really good stocks to invest in, like T-Triple-Q. So like the Sharpe ratios don't seem to be that favorable. But I actually may post like a Wall Street Saturday Lab video later on this week regarding that, and maybe we can discuss it one of these Saturdays.
No, yeah, I mean, this is my this is what I'm kind of thinking personally with my gush play. I've had a guess. I think I have some more. Yeah, I do. I definitely have some more oil and gas plays, but I think the thing to look out for is if it does hit 100, we might want to think about liquidating that position. They say to never. They say to never. I mean, not never, but they say the best time to sell a stock is when they're offering you like more money than like what it's worth, right? Like the price is too good like keep holding or like to sell it, you know. For instance, right, when Tesla went to $1,200 or $1,300, right, some people were just like, oh, the price is too good, you know, I got to sell it, you know. So I think looking out for oil to be 100 barrels, I think what should be an indicator like things are starting to get kind of tight, you know. I mean, all right, it's $90 a barrel right now, $10 more. And to be honest, man, we could probably see that by next week, you know. So I mean, that's just an indicator and something to look out for, you know. Not you know saying anything, not telling you guys how to do your investing, but just something to keep in mind.
Yeah, I mean, a lot of the I mean, it's, I hate to say it, but we were oil independent for about 2 years, and then 2020 shut that all down because we shut down all the Permian Basin, operations that were going on. Like a lot of those tiny companies went out of business, and it's not easy to get those back up and running. I mean, you need capital, you need personnel, you need recertification or whatever, and that's what I mean by the gap between a huge demand and a low supply. It's inevitably going to make the price of oil skyrocket. But anyway.
Yeah, I think we're running out of time here. Did anybody else have anything they wanted to say? All right, I guess if that's it.
Guess we can just wrap up then.
Yeah.
Stay long and stay green, everyone.